Welcome back to the lecture Introduction to Law. In this unit, we will talk about mergers and acquisitions. Mergers and acquisitions, or abbreviated M&A, is a collective term for transactions in the corporate sector. As a rule, the term is used to describe a merger or amalgamation of two companies to form a legal and economic entity, merger, or the acquisition of a company units or an entire company, acquisition. M&A stands for all transactions relating to the transfer and incumbrance of ownership rights in companies, including the formation of groups, the restructuring of groups, mergers and conversions in the legal sense, squeeze-outs, the financing of company acquisitions, the formation of joint ventures, and the acquisition of companies. The term M&A covers, for example, mergers of companies, sales of companies and corporate sales, takeover bids, transfers of businesses, leveraged buyouts, spin-offs, carve-outs, and corporate corporations, just to name a few. Whereas in a merger, the assets of the companies involved are combined and can either continue to exist as an independent organizational unit within the group or be merged into a newly created unit. In a majority acquisition, the assets of the target company are generally incorporated into the acquirer or bidder company. The basis for such a transaction is always the transfer of ownership rights in a company and thus the transfer of actively exercised management and control rights. The acquisition of ownership rights takes place either directly through the purchase of voting shares, so-called share deal or share purchase, or in the form of an asset deal through the purchase of all existing assets and liabilities for cash, in exchange for shares in the buyer or other securities, or as a hybrid of these two forms of payment. Since the term M&A is a collective term for transactions, there is no law in Germany which conclusively regulates M&A transactions. However, the German Transformation Act, Umwandlungsgesetz, regulates corporate transformations such as mergers, in German Verschmelzung, demergers, in German Spaltung, asset transfer via universal succession, so-called Vermögensübertragung, which is not very common in practice, and changes of legal form, the so-called Formwechsel. Acquisitions can be governed by the general provisions of the German Civil Code, in particular on sales contracts, and special rules of corporate law for the transfer of shares. The German Transformation Act governs the transformation of legal entities, which have their registered office in Germany. It recognizes various types of conversions. Systematically, the Transformation Act contains a general and a special part for each type of transformation. Mergers. A merger, regulated in sections 2 till 122m UmwG, results in the dissolution of a legal entity without liquidation in exchange for the granting of shares or memberships in an acquiring legal entity. It is therefore a special form of business transfer. In contrast to the acquisition of a company, the assets, asset deal or shares, share deal, are not sold and transferred by way of a transfer of individual rights against payment, but rather against the granting of shares to the acquirer. As a result of the merger, the acquiring legal entity is the legal successor via universal succession. of the transfer company. This means that as a result of the merger, the acquiring legal entity assumes all rights and obligations of the transfer company and also enters into all contracts. Contracts between the transfer company and the acquiring legal entity expire with the merger by way of confusion. In the case of the merger, a distinction can be made between two different options: the merger for new formation and the merger for absorption. In the case of a merger by way of new foundation, a new legal entity, often called NewCo, is first formed, or during the process. Then the assets of the transfer companies are transferred to the NewCo. The new formation is treated by law largely like a formation in kind. The transfer company is contributed to the NewCo like a contribution. In case of a merger by absorption, the acquiring legal entity already exists. Consequently, unlike in the case of a merger for purpose of new formation, no new legal entity is formed at the course of the merger. Here too, the entire assets, including all obligations of one or more transfer companies, are contributed. As a rule, this is done in exchange for the granting of new shares in the acquiring legal entity. The merger for absorption is therefore comparable to a capital increase in kind and is therefore largely treated in the same way by the legislator. Demergers. A demerger is a generic term for three types of demerger, namely a split up, a spin-off, and another type of spin-off. So we have in English two separate types of spin-offs. In German, this is called Aufspaltung, Abspaltung, and Ausgliederung. Shares in the acquiring legal entity are granted as a consideration. This is the common feature to the merger. The legal term demerger corresponds to the business fact of spin-out or spin-off. Split up. In a split up, a transferring legal entity divides all its assets completely. Subsequently, the assets are transferred as a special legal succession by way of universal succession. The transfer must be made to at least two other legal entities. The split may be carried out for the purpose of new foundation with transfer to a new legal entity, or for the purpose of absorption with transfer to an existing legal entity. Spin-off, first type, so-called Abspaltung. In case of a spin-off, first type, the legal entity transferring the assets remains in existence. Only part of the assets are transferred, which in themselves form a definable unit. The transfer is made to one or more either new legal entities for new formation or to already existing legal entities for absorption. These in turn must provide shares to the shareholders of the transferring legal entity. The second type of spin-off is called Ausgliederung. It results in the legal entity transferring their assets remaining in existence, but the shareholders here do not receive shares transferred by the legal entity, but these are transferred to the legal entity itself. Thus an exchange takes place. An asset of a legal entity is spun off in the latter, and the latter receives shares in the acquiring legal entity. The spin-off may be effected for the purpose of absorption or new formation. The transfer of assets, or in German Vermögensübertragung, is not an independent type of transformation. Rather, it regulates the merger and division of such legal entities that are not included as legal entities of other types of transformation. For example, the transfer of assets to the public sector or between insurance companies. In the case of a transfer of assets, all assets are transferred to another legal entity by way of universal succession, with dissolution and without liquidation. The shareholders of the transferring legal entity are not granted a share in the acquiring legal entity, but compensation in other form, for example, money. The transfer of assets in pursuant to the Umwandlungsgesetz is not very common in practice. Common is, on the other hand, the change of legal form, or the so-called Formwechsel. In the case of a change of legal form, the legal form of a legal entity is changed while maintaining its legal identity and retaining its previous shareholders. There is no legal succession, only the legal dress of a legal entity changes. Outside of the Umwandlungsgesetz, acquisitions are broadly divided into two types: the share deal and the asset deal. In a share deal, the acquisition of a company is done by purchasing shares of the company for sale. In a share deal, the buyer acquires the company, which is called target company, by purchasing the shares in the target company. This is a legal purchase pursuant to the German Civil Code. Since in a share deal, the acquisition of the target company is affected by the fact that alternatively only the owner of the target company is exchanged, but the target company remains otherwise unaffected in its composition with assets and liabilities. The share deal is in principle simpler than an asset deal with regard to the transfer. You only have to transfer the shares. In view of the fact that in a share deal only the owner of the shares in the target company is changed, the share deal has no effect on the liabilities and obligations established in the company. A buyer acquires the company with all assets and liabilities, and thus also with all contingent liabilities attributable to the company. In an asset deal, on the other hand, the assets and economic goods belonging to the company, for example, the assets and liabilities, are sold with the associated employment, contractual and legal relationships and transferred to the buyer by way of singular succession. It is not the shareholder who sells his company shares or assets, but the company itself that sells its company-related assets. In an asset deal, individual assets are sold by the company. In this case, the principle of certainty under property law must be observed. All assets that are to be sold and all liabilities that are to be assumed must be recorded individually and with sufficient specificity and transferred to the purchaser in each case in compliance with the respective provisions required for this purpose. It should also be noted that the consent of the respective contractual partner is required for the transfer of contracts to the purchaser, but this often cannot be obtained prior to the signing of a purchase agreement for reasons of confidentiality. If the respective contractual partners do not consent, the contracts are not transferred to the purchaser and remain with the company. This does not apply to the employment relationships associated with the business to be acquired. These are transferred to the purchaser by operation of law, section 613a of the German Civil Code, although the employees do have rights of objection in the event of an asset deal. From a legal point of view, a purchaser can in principle choose what he wishes to acquire. In particular, he can refrain from taking over receivables and already established liabilities and other contingent liabilities, so that they remain with the selling company. These are the main difference between share deal and asset deal. Let's take a look on the typical phases of an M&A transaction. The common phases in an M&A transaction are the initial phase, the search phase, the review phase, the valuation and detailed analysis phase, the phase of due delegation, the negotiation phase, the signing and the closing phase. Let's take a look at an example Let's say somebody wants to sell a company. We want to go step by step through the different phases. First, the initial phase. In this phase, the idea of carrying out an M&A transaction arises. As a rule, the transaction structure is mostly determined at this stage. It is particularly important to decide whether the transaction is to be carried out by way of an asset deal or a share deal if you want to sell your company. In some transactions, the seller carries out the due diligence, a careful examination of the company to be sold. That's the so-called vendor due diligence. The main motivation for such vendor due diligence is that the seller wants to obtain a precise overview of the strengths, but also the weaknesses of the company and thus of any liability risks. Second, search phase. In the search phase, suitable targets for the M&A transaction are sought. Potential interested parties are approached by investment bankers or so-called M&A consultants. For reasons of confidentiality, information is passed on an anonymous basis, and only key data of the company to be sold is communicated to potential acquirers in order to arouse their interest in the target company. Third, the review phase. Once possible transaction targets have been identified, a confidentiality agreement, also known as non-disclosure agreements or NDA, is first concluded in order to prevent sensitive information disclosed in the interested parties in the course of the further process from becoming public or being used by interested parties to detriment of the seller. Next, it is examined whether a potential target is generally suitable for the specific transaction planned. After that, there's the evaluation and detailed analysis. If the target is generally suitable for the transaction, the target is evaluated and analyzed in detail. The parties usually express their fundamental and at the same time serious interest in carrying out the transaction by means of a written letter, which is often called letter of intent, heads of terms, or memorandum of understanding. In addition to the transaction structure, the anticipated purchase price and the further procedure are regularly set out in the letter of intent. However, the letter of intent or memorandum of understanding does not usually have any legally binding effect. An important part in practice is the due diligence. In the next phase, the so-called due diligence is carried out. A due diligence represents a comprehensive examination of the target. The main aim is to identify possible risks that would be transferred to the acquirer as a result of the transaction. The areas of law, legal due diligence, finance, financial due diligence, taxes, tax due diligence, and human resources, HR due diligence, are particularly relevant. Through this examination of the company, the buyer attempts to reduce the information and knowledge advantage of the seller and to minimize the probability of a bad purchase. In addition, a review of the factors of the target company that are relevant to valuation and thus to the purchase price, the determination of a basis for the catalog of warranties to be included in the company purchase agreement, and the goal of determining an optimal transaction structure are also mentioned. The provisions of the target's data is regularly carried out by means of a virtual data room to which the prospective buyer has access. In most cases, new documents are continuously added to the data room. The prospective buyer has the possibility to ask the target questions. While due diligence is still ongoing, the drafting and negotiation of the company purchase agreement begins. This can be a share purchase agreement, SPA, or in case of an asset deal, an asset purchase agreement, APA. The content of an SPA or APA generally follows a specific structure. First of all, the SPA or APA names the parties, stating all relevant data to identify them. Then the corporate relationships of the prospective buyer and the target are listed. This is followed by the exact description of the object of purchase. In the case of a share deal, this means the exact shares to be purchased, and in the case of an asset deal, the assets to be purchased. The agreement on the purchase price is probably of greatest importance. Here, certain instruments of purchase price adjustments are agreed on a regular basis. This is against the background that the target company continued to be active on the market between the last balance sheet date, signing and closing, and therefore the determined purchase price may no be longer appropriate. Typical instruments are locked box method, purchase price adjustment clause, and earn-out clause. Locked box method means that a fixed purchase price is determined based on the last annual financial statements. In addition, it is ensured in the purchase agreement that there have been no business transactions and no cash outflows outside the ordinary course of business since the reporting date of the last financial statements until the closing. Purchase price adjustment clauses means based on the last annual financial statements, a provisional purchase price is determined, which is paid to the seller at closing. A closing date balance sheet is then prepared, on the basis of which the actual purchase price is determined and the difference is paid to the seller or buyer after the closing date balance sheet becomes binding. Earn-out clauses. Under earn-out clauses, a fixed purchase price is paid at closing depending on further development of the company and the exceeding of certain thresholds specified in the contract at a certain point in the future. A further cash payment specified in the contract may become due. After the purchase price arrangements, guarantee agreements are regularly concluded. In such agreements, the German warranty law is waived and replaced by independent warranty promises to be given by the seller. The buyer wants to protect himself against risks and seeks an extensive warranty catalog, high liability limits, a so-called cap, and long limitation periods. This is offset by the interest of the seller, who wants claims arising from a breach of warranty to be excluded if the buyer is aware of the breach of warranty or is unaware of it due to gross negligence. From the buyer's point of view, it must be questioned whether the factual enforceability of a possible warranty claim is ensured. Here it is necessary to secure the claim if necessary, for example, by retaining part of the purchase price or paying it into a trust account, and only paying it to the buyer at a later date. In addition, SPA and APA contain numerous other clauses, such as on jurisdiction or applicable law. The contract negotiation is concluded by the signing of the contract by both parties. The contract then becomes legally binding. Closing is the handover phase. With the fulfillment of the obligations of both parties, the contracts are fulfilled on both sides. The form in which the closing takes place depends largely on whether a conditional transfer of the shares has already been made in the purchase agreement or whether a separate transfer agreement is required. Typically, the parties meet, establish that closing conditions have been met, sign the transfer agreement and the so-called closing protocol. That's all what you need to have heard of in case of M&A. For this lecture, there are a lot of specific problems which are M&A related, which are very important in praxis, but you will learn them at a later time. Learning by doing is here often the best practice. Till next time.